So if you look at the global energy market, we usually expect to see like a localized cause and effect, you know?
Right, yeah, like you drill a well, oil comes out, and revenue goes up.
Exactly. A drilling rig turns to the right in West Texas, and the cash flows.
Yeah.
But modern energy production has just, well, it's completely shattered that linear model.
It really has. I mean, it's a totally non-linear dynamic system now.
Yeah. We are looking at an ecosystem so intensely interconnected that like a change in sovereign monetary policy in North Africa can somehow dictate where a steel pipe goes in the Gulf of Mexico.
Which is just wild to think about.
It is. And meanwhile, you've got these mathematical algorithms running a trading desk in Houston that are generating, frankly, more cash than the physical wells they were originally built to support.
Because you have these geological realities just sort of colliding with macroeconomic debt cycles.
Yeah.
Right? And it's all constrained by the physical limits of pipelines, all wrapped up in this layer of geopolitical risk that can just reprice the entire board overnight.
Exactly. So when you look at a major exploration production company today, you are not just analyzing roughnecks and drill bits.
No, not at all. You are basically analyzing a highly leveraged financial institution, one that just happens to deal in hydrocarbons.
Right, which brings us to the actual subject of our deep dive today. We are looking at the APA Corporation's first quarter 2026 earnings call.
Yeah, and we're pulling directly from the executive commentary, the Q&A with the Wall Street analysts, and, all the accompanying financial disclosures.
And just to set the stage for you listening, our goal here isn't to just recite the headline numbers like a textbook. We want to deconstruct the actual mechanisms behind those numbers.
Right, because we want to understand how a global player like APA manages to extract these massive windfall profits from broken domestic markets.
While at the same time navigating some really severe geopolitical crosswinds internationally. And look, our style here is data forward, but plain language. We want to take all that Wall Street jargon, break it down, and figure out what it actually means for you if you're holding the stock or thinking about buying in.
So we're going to hit the headline numbers, the story driving those numbers, their future guidance, and then we'll give you our bottom line on whether this is a bullish or bearish signal.
Yeah, let's jump right into it. I think the overarching theme of this specific quarter is really operational pragmatism.
Oh, for sure. It's pragmatism overriding those traditional production metrics.
Right, because management is aggressively pulling all these financial and logistical levers to exploit market inefficiencies. They aren't just blindly pumping volume into an oversupplied basin.
Yeah, which is smart. But before we get into those operational weeds, we need to talk about the macro environment, because the call opens with CEO John Christman directly addressing the tensions in the Middle East.
Yeah, he kind of had to, right?
Yeah.
APA has this massive legacy footprint in Egypt.
Huge footprint. And in the current climate, operating in that region carries a really significant risk premium. Wall Street is constantly modeling for disruption.
Right, whether that's supply chain bottlenecks in the Red Sea or just localized political instability.
Exactly. So Christman had to immediately establish the baseline security of their operations. And he confirmed that their Egyptian footprint remains completely safe and undisrupted.
Which is a huge relief for investors.
Right. And he leaned heavily on their decades-long track record and deep integration with the host government over there. But that geopolitical overhang is exactly what drives the volatility in the global crude benchmarks.
Yeah, it creates a physical market that is incredibly tight, even if the paper markets, occasionally sell off on macro fears.
Which is a really important distinction.
It is. And I want to focus on that disconnect between the physical market and the paper market, because it shows up literally right away in the financial results. Let's look at the headline numbers.
Okay, let's do it.
So APA reported a GAAP net income of $446 million, which comes out to $1.26 per share.
Right.
But the adjusted net income, which is the number management actually wants you to pay attention to, was $489 million, or $1.38 per share.
Right. So a pretty noticeable gap there.
Yeah. And the single largest driver of that $43 million difference is this $37 million charge for unrealized derivative instrument losses. Management basically dismisses this as paper math. But I want to get your take on this. Is it just paper math, or is it an actual opportunity cost where they locked in their hedges too low and just missed out on the price spike?
Well, it is an opportunity cost technically, but framing it as a failure really misunderstands the function of a corporate hedge book.
How so?
So when an E&P company enters into a derivative contract like a swap or a collar, They aren't out there trying to day trade the market. That's not the goal.
Right. They aren't hedge fund managers trying to beat the S&P.
Exactly. They are securing a floor price to guarantee the cash flow they need to fund their capital expenditure program and, to service their debt covenants.
Okay, that makes sense.
But mark-to-market accounting rules require them to value those contracts against the current forward curve at the end of every single quarter.
Right. The GAAP rules force them to take that snapshot. So if they hedged Brent crude at, say, $75 and the forward curve shifts up to 85, the accountant steps in and says, hey, you are technically underwater on this contract by $10.
Yeah, but the critical word in that filing is unrealized. That $37 million loss hasn't actually settled in cash.
Right.
The physical barrels they sold during the quarter captured the higher market price. That derivative loss is merely a reflection of the opportunity costs they would incur if those contracts somehow settled today.
Oh, I see. So analysts strip this out to calculate adjusted earnings because it kind of obscures the underlying cash generation capacity of the actual oil field.
Precisely. It's noise. You want to look at the cash generation because the physical premiums they are commanding right now are just staggering.
Yeah, let's talk about that. The screen price of oil is one thing, but APA noted they are securing a dated Brent premium of $8 to $10 over the screen price for the second quarter.
Which is huge.
Yeah, and they expect it to settle into a $5 to $10 premium later in the year. And even domestically, they are capturing a $2 to $5 premium on WTI. So can you explain the mechanics of a physical premium for, a retail investor? Why are refineries willing to pay $10 above the quoted futures price for a barrel of crude?
It really just comes down to the difference between paper barrels and wet barrels.
Wet barrels, okay.
Yeah. The futures market, which gives us the screen price deals in these standardized contracts for delivery months in the future.
Yeah.
But a refinery operator who is looking at a turnaround schedule, they need specific grades of physical crude delivered to a specific terminal next week just to keep the distillation columns running.
Right. They can't refine a piece of paper.
Exactly. So when global inventories are drawn down or when, geopolitical tension forces tankers to reroute all the way around the Cape of Good Hope, the localized supply of those wet barrels tightens up dramatically.
Oh.
So refiners basically just bid up the physical premium to ensure they actually have feedstock. It is a pure reflection of immediate logistical scarcity.
And it suggests the physical market is much healthier than the macroeconomic sentiment might make you think.
Absolutely.
But okay. While oil is commanding these massive premiums, we have the exact opposite situation happening in the U.S. natural gas market. Which brings us to the Permian Basin operations in West Texas and New Mexico.
Yeah, this is where things get really interesting.
Because this is their growth engine. They have transitioned this asset to be entirely unconventional, focusing on these long lateral shale developments, and they actually raised their 4-year oil production outlook to 122,000 barrels per day. But the striking detail to me is that they are achieving this volume growth with lower capital intensity and fewer drilling rigs. How does that work?
Well, that is the defining metric of operational execution in the shale patch right now, capital efficiency.
Right.
Because if you can flatten your decline curve and increase initial production rates without deploying additional, heavy iron, your margins just expand exponentially.
And how is APA actually doing that?
They are achieving it through advanced completion designs. So they are likely utilizing higher proppant loading, optimized stage spacing, and they're combining all of that with highly targeted uptime projects.
Yeah, they specifically highlighted a $100 million investment this year strictly for uptime projects, which, kind of implies they had a downtime problem to begin with.
Well, yeah. When you're running thousands of unconventional wells, things break. Electrical submersible pumps fail, gas lift systems freeze up, flow lines get choked.
So spending $100 million just to keep the existing wells flowing suggests a pretty fundamental shift, right? Moving from just blindly drilling new holes to actually maximizing the life cycle of the assets they already have.
Exactly. It's a mature basin strategy. In the early days of the shale boom, the strategy was just to drill as fast as possible to hold acreage.
Right. The land grab phase.
Yeah. But now the basin is maturing. The gas to oil ratios are changing. The focus is entirely on free cash flow generation, which means minimizing operational expenditures and reducing the time a well is offline for maintenance.
But that changing gas to oil ratio brings us to honestly the most complex and frankly bizarre dynamic of this whole earnings call. The physical natural gas market in West Texas is completely broken.
Oh, it's a mess.
At the Waha Trading Hub, Prices haven't just dropped. They have gone deeply negative. We're talking about a scenario where a producer literally have to pay someone to take their natural gas away.
Yeah.
And APA responded to this by physically curtailing production in the first and second quarters.
Yeah.
They are intentionally shutting in wells.
Which is the only rational economic response to a negative localized price.
Okay, but I have to push back on the long-term impact of that decision. Because, shutting in an unconventional well isn't like turning off a faucet in your kitchen.
No, it's not.
When you shut in a shale well, you disrupt the reservoir pressure. And when you eventually turn it back on, it rarely returns to its previous production trajectory. You risk permanent damage to the ultimate recovery of that well. So is management essentially sacrificing the long-term geological health of the asset just to dodge a short-term pricing anomaly at Waha?
I mean, that is a highly sophisticated concern, and it's something reservoir engineers debate constantly. The risk of near wellbore scaling or pressure depletion during a shut-in is absolutely real.
Right.
However, you have to weigh that geological risk against the immediate, tangible financial destruction of selling millions of cubic feet of gas at a negative price.
Yeah, paying people to take your product is tough to justify.
Exactly. So APA's engineers have likely modeled the pressure dynamics very carefully. They are selecting wells for curtailment that are mature enough to handle the shut-in without catastrophic degradation.
Okay, that makes sense.
Furthermore, they are primarily targeting dry gas wells or wells with very high gas-to-oil ratios. They are preserving their oil-heavy wells where that $80+ crude price easily subsidizes the negative gas penalty.
Got it. Now, this Waha bottleneck is just a fascinating infrastructure failure. And I think the best way for you to understand it is to look at data networks.
Oh, I like this analogy.
So if you have a massive data center trying to push petabytes of information through just a standard fiber optic cable, the bandwidth maxes out. You get packet loss. The system physically cannot process the volume.
Right.
The Permian Basin is the data center, and the pipelines heading to the Gulf Coast are those fiber optic cables. Because every single oil well they drill also brings up associated natural gas.
Yeah.
The basin is totally over-provisioned. The compressor stations are running at maximum pressure, and they literally cannot force another molecule into the pipe. So the gas just drops out of the system, and the local price collapses to zero.
That analogy perfectly isolates the problem. It is an issue of transmission, not extraction.
Right.
The commodity itself has intrinsic value, but the local physical constraint destroys its localized price. And this actually leads us to the most astonishing financial maneuver in the entire earnings transcript.
Exactly. This is the part that demands some deep analysis. Because APA is physically shutting down gas wells because the local price is terrible. But simultaneously, they announced they expect to generate $1.1 billion in pre-tax revenue this year, entirely from their oil and gas trading portfolio.
Incredible.
$300 million of that is tied to global LNG pricing, sure. But the vast majority is derived from pipeline transportation differentials in the United States.
Right.
They were making $1 billion trading the exact same commodity they're refusing to pull out of the ground. It sounds like an arbitrage cheat code.
It really does demonstrate the immense value of midstream foresight. We have to dissect the mechanics of basis differentials here to understand how an E&P company basically acts as a highly profitable hedge fund.
Yeah, let's break down that basis differential for the listener in plain English. The basis is simply the price difference between two physical locations.
Right.
So in this scenario, we have the Waha hub in West Texas, where the price is practically zero or negative, and the Houston Ship Channel, or Katy hub on the Gulf Coast, where natural gas actually commands a healthy price for industrial use and LNG export.
Right. So years ago, APA management committed to these long-term firm transportation contracts, or FT contracts, on the major pipelines connecting the Permian to the Gulf.
Okay.
They agreed to pay demand charges to reserve space in that pipe, regardless of whether they actually used it. At the time, that looked like a sunk cost, a defensive move to ensure their own gas could eventually get to market.
But now, that reserve pipe space is arguably the most valuable asset in their entire U.S. portfolio.
Precisely. Because they own that FT capacity, they don't even have to produce their own gas to make money.
Wait, really?
Yeah, they can just go into the Waha market, take gas off the hands of desperate producers for free, or honestly, even get paid to take it. Load it into their reserved pipeline space, transport it to the Gulf Coast, and sell it at full market value.
That is just wild.
The $1.1 billion is not revenue from drilling. It is a pure arbitrage profit generated by monetizing that basis differential.
It is an absolute masterclass in arbitrage, but I mean, market inefficiencies of this magnitude never last forever.
Yeah.
The old saying is the cure for high prices is high prices, and the cure for wide differentials is steel in the ground.
Exactly.
Analyst Doug Leggett actually pressed management on the duration of this trading windfall. Because pipeline operators aren't blind, right? They see the bottleneck and they are actively building capacity to relieve it.
Yeah, the transcript specifically cites the upcoming infrastructure build-out. You have the GCX expansion, the Blackcomb pipeline, and the Hugh Brinson project. And all of those are slated to come online later this year and into 2027.
Right. And as those projects add billions of cubic feet per day of takeaway capacity, the network bandwidth increases. The packet loss stops.
Exactly.
Gas flows freely out of Waha, which pulls the local price up, while at the same time flooding the Gulf Coast, which pushes the coastal price down. So the differential just collapses.
Yeah, and CFO Ben Rogers acknowledged this reality on the call. He guided that the trading windfall will shrink from $1.1 billion this year to roughly $400 million in 2027.
Which is still a lot of money, but a massive drop.
Right. Which highlights why APA is maintaining their core operational discipline here. They are treating that $1.1 billion as a transient windfall, not a structural permanent baseline.
That's a key takeaway.
Yeah. Their U.S. upstream capital expenditure budget remains completely unchanged at $2.1 billion, with 55% heavily front-loaded into the first half of the year.
So they are basically using the trading cash to fund the steady, grinding work of drilling new lateral wells in the Permian.
Exactly. Ensuring they have the physical production ready when those midstream constraints eventually normalize.
And that is a perfect transition to the other side of their portfolio, because the U.S. Permian is characterized by this hyper-growth, massive infrastructure bottlenecks, and wild trading volatility.
Yeah, it's very chaotic.
But to fund a multi-billion-dollar CapEx program, you need a stabilizing counterweight. You need a baseline of predictable, low-decline cash flow. And for APA, that bedrock is their international operation in Egypt.
Oh, the Egyptian portfolio is the absolute anchor of the company.
Right.
It operates under a completely different geologic, political, and financial paradigm than the unconventional shale in Texas.
Yeah, so let's start with the operational engineering over there in the Western Desert. They have managed to arrest the decline rates and stabilize gross production at approximately 121,000 barrels per day for 4 consecutive quarters.
Which is incredible.
And they are forecasting a very shallow decline to roughly 118,000 barrels per day for the remainder of the year. In a mature conventional basin, holding production flat like that is a massive engineering accomplishment.
It really is.
The transcript attributes this stability to targeted waterflood investments and running a steady program of mid to high teens workover rigs.
Right, so we need to analyze the mechanics of a waterflood to appreciate the capital discipline here.
Let's do it.
The Western Desert fields are very mature. The primary reservoir drive, which is the natural geologic pressure that pushes the oil to the surface, has largely been depleted over time.
Right, the natural fizz is gone.
Exactly. So to maintain production, APA utilizes secondary recovery. They basically inject pressurized water into injection wells to sweep the remaining oil toward the producing well bores.
But the efficiency of that sweep is everything, right? I mean, if the water just channels through the rock and bypasses the oil, you're spending millions pumping water for absolutely no return.
Exactly. And that is where the workover rigs come in.
Okay, explain that, because a lot of people just hear the word rig and assume drilling.
Right. A workover rig doesn't drill new wells. It performs heavy maintenance on existing well bores.
Got it.
So in a waterflood environment, that means pulling and replacing those fail electrical submersible pumps, or running wireline to plug off zones that have totally watered out, and then reperforating the casing to access bypassed pay zones.
Wow, okay.
Yeah, so running 15 to 19 of these workover rigs continuously, it just represents a relentless, grinding maintenance schedule designed to extract every possible drop from a declining asset.
But, you know, the physical engineering is actually less complex than the financial engineering required to operate in Egypt.
Oh, absolutely.
This is where the earnings call gets deeply counterintuitive. APA operates in Egypt under a production sharing contract, or PSC.
Right.
And on the call, management noted that because the global price of Brent crude has rallied, APA's adjusted production volume guidance is actually decreasing.
Yeah, that always confuses people.
To an observer accustomed to U.S. royalty systems, this makes zero sense. The price of oil goes up, the physical volume coming out of the ground is flat, but the volume APA books on its financial statements goes down.
I know, it sounds backward. But this is the defining feature of a production sharing contract. And it requires a fundamental shift in how you view ownership.
Okay, lay it out for us.
In the United States, you lease the mineral rights, you drill the well, you own the oil, and you pay a royalty to the landowner.
Standard stuff.
But in Egypt, the sovereign state owns the oil outright. APA is essentially a highly capitalized service contractor hired to extract it.
So under a PSC, APA fronts 100% of the capital. They pay for the seismic surveys, the drilling rigs, the water flood infrastructure, everything.
Correct. And the mechanism for APA to recoup that massive capital outlay is called cost oil.
Cost oil.
Okay. Yeah. The Egyptian government basically allocates a specific percentage of the daily production to APA strictly to repay their expenses.
And this is where that inverse relationship between price and volume occurs. Let's model this for the listener.
Good idea.
So it's like agreeing to paint a house for $1,000, but getting paid in shares of Apple stock.
I like that.
If Apple stock goes up, you get handed fewer shares, but you still get your $1,000 of value.
Exactly. So let's look at it with oil. Assume APA incurs $1 million in recoverable costs. If Brent crude is trading at $50 a barrel, the Egyptian government must hand over 20,000 physical barrels of cost oil to APA to clear that $1 million ledger.
Right. But if geopolitical tensions drive Brent crude up to $100 a barrel, the math changes instantly. At $100 a barrel, the government only needs to hand over 10,000 physical barrels to settle the exact same $1 million cost recovery.
Right. So APA takes physical possession of fewer barrels, and therefore their reported adjusted volume declines.
Even though the economics are identical.
Exactly. The remaining barrels, which are called the profit oil, are then split between APA and the Egyptian state according to a negotiated tier system.
Got it.
When prices spike, the sovereign state retains a larger share of the physical commodity. But for APA, the economic value is preserved. The cash flow remains robust. It is simply delivered through fewer, higher-priced barrels.
So when a retail investor sees lowered volume guidance in a PSC framework during a bull market, it is not an operational failure.
No, not at all.
It is just a mechanical accounting function of cost recovery. That distinction is so vital.
It really is.
But the PSC dynamic is only half the story in Egypt. The other half is macroeconomics and domestic energy security.
Right.
APA is currently running a 50-50 split between oil and gas rigs in the country. They are intentionally dedicating half their drilling capital to natural gas. Why? Because Egypt is facing severe domestic energy constraints.
Yeah. They have a massive growing population demanding electricity, and their power grid relies heavily on natural gas.
And the macroeconomic situation in Egypt is delicate right now. They've faced currency devaluation and severe foreign exchange shortages. Importing liquefied natural gas, or LNG, from the global market requires hard currency.
Right, U.S. dollars.
Yeah, which strains the sovereign balance sheet.
Yeah.
And the transcript highlights that APA is directly alleviating that pressure.
Yeah, management noted that their domestic gas production is saving the Egyptian government the equivalent of 2 full LNG import cargoes every single month.
That is massive. By producing the gas domestically, APA is basically acting as a localized utility, providing critical baseload fuel for the national grid.
And in return, APA secures highly favorable economic terms. They have locked in a domestic gas price of roughly $4.25 per 1,000 cubic feet.
Which is great.
Yeah, and management noted this price is geared around a $75 to $80 Brent oil price. This provides APA with an insulated, highly predictable revenue stream that is shielded from the wild swings of the global spot market.
It basically aligns the corporate incentives of the E&P with the sovereign security incentives of the host nation. It is the ultimate symbiotic relationship.
Exactly.
But operating in this environment isn't immune to global inflation. They noted specific inflationary pressure on diesel fuel in Egypt.
Oh, yeah.
Running remote drilling locations and heavy workover rigs requires massive amounts of diesel for power generation. As global refined product prices rise, that operational expenditure increases.
Right.
But this is where the global portfolio acts as a hedge. The $100 million in uptime project savings they are generating in the Permian Basin in the U.S. is effectively subsidizing the diesel inflation in North Africa.
It's brilliant. The efficiencies in Texas fund the operational reality in Egypt. It perfectly illustrates the portfolio theory of capital allocation. You use diversified geographic and commodity exposure to smooth out localized volatility.
Which brings us to the most critical question for any legacy extractive industry. Every barrel of oil APA produces today is a barrel they cannot sell tomorrow.
Right, the depletion problem.
The Permian is maturing. Egypt requires relentless water flood maintenance. To survive into the 2030s, they have to replace those reserves. So how is management allocating this massive free cash flow to secure their production profile a decade from now?
Well, they are funding frontier exploration and deepwater mega projects, and the absolute centerpiece of their future strategy is the Grand Morgoe project in Block 58 offshore Suriname.
Ah, the Suriname project. It's fascinating. They confirmed on the call the Grand Morgoe remains on track for first oil in mid-2028. They refer to it as their organic high-margin growth engine. Let's analyze the economics of deepwater development, because it's so different. Unlike the Permian, where you can drill a well for $10 million and have it producing in weeks, offshore Suriname requires a multi-billion-dollar upfront investment to construct a floating production storage and offloading vessel, or an FPSO.
Yeah, the cycle times in deepwater are massive. You spend 5 years and billions of dollars on appraisal wells, subsea tiebacks, and shipyard construction in South Korea or Singapore before a single drop of oil flows.
But the margin profile is completely inverted compared to shale, right? Explain that inversion for us, because shale just seems so much faster and cheaper.
Well, shale is fast, but it suffers from steep decline curves. You have to constantly drill new wells just to keep production flat. It is highly capital intensive over the life of the asset.
Right, the treadmill.
Exactly. But an offshore FPSO requires massive upfront capital. However, once the facility is commissioned and the subsea wells are flowing, the lifting costs per barrel are incredibly low.
Like how low?
Often in the single digits. The reservoir pressure is immense, the decline rates are shallower, and the facility produces hundreds of thousands of barrels a day for decades. Suriname is designed to be the cash cow of the 2030s, replacing the mature declines of their legacy portfolio.
I understand the economic theory, but I have to challenge the timeline and the execution risk here. Mid-2028 for first oil.
It's aggressive.
The global supply chain for deepwater equipment is currently stretched to the breaking point. Shipyards are backed up, subsea umbilical manufacturers are sold out, and offshore rig day rates are just skyrocketing.
Yeah.
Are we supposed to take management's 2028 timeline at face value without heavily discounting the probability of severe cost overruns and delays?
I mean, the execution risk is the primary reason the market discounts the net present value of frontier projects. It's a valid concern. However, APA is mitigating this by partnering with Total Energies, who is the actual operator of the block. Total has extensive experience managing mega project supply chains and executing FPSO builds. So yes, the 2028 target is aggressive, but it is factored into their long-term capital framework.
Okay, fair enough. Now, while Suriname is moving toward development, their other frontier project in Alaska is facing a pretty hard reality check.
Yeah, the strategic pause.
APA has been exploring the North Slope, but they announced they literally halted drilling operations for the winter season.
Which is a phenomenal example of geological discipline overriding the urge to just, put a bit in the ground to show progress.
The details on this are striking. They paused operations to reprocess 3D seismic data and integrate the core samples and logs from 2 previous wells, Sockeye and King Street.
Right.
And by stopping to actually run the algorithms and analyze the data, CEO John Christman admitted they realized they hadn't even drilled a Sockeye well in the thickest part of the reservoir. They found the oil, but they missed the optimal geologic trap.
Right. And reprocessing seismic data using advanced algorithms allows geophysicists to build a much higher resolution model of the subsurface.
But it takes time.
Immense computing power and time. And admitting you missed the sweet spot is painful on a quarterly call, but it is vastly superior to deploying a rig into the Arctic winter and drilling a $40 million dry hole because your subsurface map was off by 500 feet.
Yeah, that makes total sense. So they are returning next winter armed with better data for a 2-well exploration and appraisal program. But the logistics of Alaska are just brutal.
No, absolutely brutal.
CFO Ben Rogers broke down their exploration budget for the year. Out of their multi-billion-dollar CapEx program, they're only spending $70 million on pure exploration.
Right.
$50 million of that is for Suriname engineering, and $20 million is allocated to Alaska. But that $20 million isn't even for drilling. It is literally just to build the ice roads on the tundra to position the heavy equipment for next year.
Yeah, the environmental restrictions on the North Slope mandate that you can only move heavy iron during the deep winter freeze to protect the permafrost. Building ice roads is a sunk logistical cost that must be incurred before a rig even arrives on location.
It really puts the entire enterprise into perspective. They're spending $20 million to freeze water into a road just for the right to spend another $50 million next year to see if the computer models are correct.
It does. It highlights the fundamental tension of the public E&P model. Wall Street demands quarterly free cash flow yields and immediate capital returns.
Right.
But the physics of replacing reserves requires funding projects with 10-year lead times and massive upfront logistical hurdles.
Which is why the exploration budget is strictly capped at $70 million. Management is essentially buying a long-dated call option on future production.
Exactly.
They are funding the 2030s, but they are doing it with a fraction of their current cash flow, ensuring it does not cannibalize the immediate returns promised to shareholders today.
Yeah, and that leads us to the final and perhaps most scrutinized segment of the earnings call, the balance sheet, cost cutting, and their capital return framework.
The bottom line. Let's get into it.
Right. After fully funding the U.S. drilling program, managing the Egyptian water floods, and paying for the Alaskan ice roads, APA is still projecting a mountain of free cash flow, roughly $2.2 billion for the full year.
That's a lot of cash.
Yeah.
So how management allocates that $2.2 billion is the ultimate test of their macroeconomic outlook, right?
Exactly. And their allocation strategy right now heavily prioritizes debt reduction over equity repurchases, which is a significant shift in tone.
Let's look at the raw numbers. Net debt currently sits at $4.1 billion. That is actually a slight increase from the end of the previous year, which definitely raised some eyebrows.
Yeah, but Rogers explained it as a working capital timing issue. A late quarter spike in crude prices inflated their accounts receivable, meaning the oil was sold, but the cash hadn't cleared the bank yet. And that was combined with the standard first quarter payout of the previous year's incentive compensation.
So the working capital fluctuations are just noise. The critical signal is the stated objective. They are ruthlessly targeting a reduction to $3 billion in net debt.
And the execution on that front is very aggressive. In April alone, they retired $555 million of near-term bonds.
Oh, wow.
Yeah. Year to date, they have paid down $634 million in principal. By clearing out the front end of their maturity wall, they have created a massive runway. APA literally has no debt maturing until December 2029.
That has a huge advantage.
The financial leverage of paying down debt in a high interest rate environment cannot be overstated. By retiring those bonds, Rogers noted that their annualized interest expense will be $150 million lower by the end of 2026 compared to 2024.
That drops right to the bottom line.
Exactly. When you combine that with operational efficiencies, their total cash costs will be structurally reduced by $600 million. They are lowering the break-even price of the entire corporation.
But and here's where the bottom line gets tricky. The relentless focus on debt reduction created a lot of friction on the call. Analyst John Freeman pointedly questioned the pause in share buybacks.
Yeah, the analysts weren't happy about that.
Let's look at the history here. APA has a stated framework to return a minimum of 60% of free cash flow to shareholders. Historically, they have over-delivered, returning 71% since 2021.
Right.
But currently, the buyback program is essentially dormant. I have to push back on management's narrative here.
Yeah.
If they truly believe in the long-term value of their assets in Suriname, Egypt, and the Permian, why aren't they aggressively buying their own stock?
Wow.
Is the pause in buybacks a tacit admission by management that their equity is currently overvalued? Because retail investors look at that and get nervous.
That is the exact thesis the analysts were trying to validate. But you have to view capital allocation through the lens of cost of capital and macro risk.
Okay, explain.
Management vehemently denied that the pause reflects a bearish view on their valuation. Instead, it is a defensive maneuver in a deeply uncertain global environment.
Explain the defense.
Okay.
Because usually, retiring shares is seen as the ultimate confidence signal.
It is, in a stable environment. But look at the landscape right now. We have escalating conflict in the Middle East, threatening the Strait of Hormuz, inflationary pressures keeping central bank interest rates elevated, and massive volatility in the physical gas markets.
Right.
In an environment where the cost of debt is high and macro shocks are highly probable, a pristine balance sheet is the ultimate competitive advantage.
So you're building a fortress.
Exactly. By pushing their nearest debt maturity out to 2029, APA is essentially bulletproofing the company against a sudden credit freeze or a collapse in commodity prices. They are opting for survivability and optionality over a short-term bump in earnings per share.
Okay, I see that.
Once they hit that $3 billion debt target, the balance sheet is de-risked, and they can theoretically redirect that entire free cash flow stream back into aggressive share repurchases.
Exactly. They are sacrificing immediate equity yield to build an impenetrable financial fortress. If you are holding the stock, this is a long-term play. You aren't in it for a quick flip. You are holding for that 2028 Suriname cash flow.
Right. Now, there are two final financial disclosures buried at the very end of the call that I think perfectly illustrate how government policy impacts capital allocation.
Oh, the UK tax.
Yes. First, APA retains legacy operations in the North Sea, and they booked a $230 million current tax expense, almost entirely driven by the United Kingdom. Operations in the UK are currently subject to an energy profits levy, resulting in a punitive 78% effective tax rate.
A 78% marginal tax rate just destroys the net present value of any future investment. When a sovereign government implements a windfall tax of that magnitude, they effectively guarantee the rapid decline of their domestic production. Capital is completely fungible.
Right. APA will simply take the cash generated in the North Sea and deploy it into the Permian Basin or Suriname, where the fiscal regimes are stable and the returns are not confiscated.
Exactly. And the inevitable result of abandoning a mature basin is decommissioning.
Which brings us to the final data point, a $20 million increase in decommissioning spend. Decommissioning, which means plugging abandoned wells and dismantling offshore platforms, is a pure liability. It generates zero revenue.
Right. It is an asset retirement obligation that just sits on the balance sheet.
Initially, a $20 million increase sounds like cost inflation, but management clarified it is actually a strategic acceleration.
Yeah. They are utilizing their strong current cash position to pull forward decommissioning work on platform wells in the Gulf of Mexico. Rather than waiting for the liability to compound, they are proactively deploying rig crews to plug the wells and clear the asset retirement obligation off the books ahead of schedule.
It is another form of balance sheet cleanup.
Exactly.
Wow. We have really dissected this earnings call from every conceivable angle. We've covered the geophysics of the Alaskan permafrost, the pipeline bandwidth constraints in West Texas, the accounting mechanics of Egyptian production sharing contracts, and the macroeconomics of retiring corporate debt.
We really went everywhere.
We did. And the overarching narrative is clear. APA is not operating a static machine. They are running a highly dynamic portfolio, shifting capital aggressively to exploit arbitrage in the midstream markets while rigorously defending their balance sheet against global volatility.
It requires a management team capable of executing granular engineering tasks, like replacing electrical submersible pumps in the Western Desert, while simultaneously hedging billion-dollar macro risks on the global derivative markets. It's not easy.
No, it's not. And as we conclude this analysis, I want to pivot to a broader concept that underpins everything we've discussed today. I want to leave you with a final provocative thought.
Go for it.
The mainstream narrative surrounding the global economy is entirely focused on the energy transition. The theoretical shift from hydrocarbons to renewables.
Right, that's all anyone talks about.
But the reality hidden within this earnings call points to a completely different, much more immediate transition. Energy security.
Energy security is the unstated mandate driving sovereign policy right now, which in turn dictates corporate strategy.
Look at Egypt. Their immediate crisis isn't about building solar farms. It is about securing enough domestic natural gas to keep the lights on without draining their foreign currency reserves on imported LNG. For developing economies, the quote-unquote transition often simply means moving from expensive imported oil and coal to cheaper, domestically produced natural gas.
And that reality forces legacy exploration and production companies into a dual mandate.
Exactly. In the coming decades, a company like APA must operate with a split personality. In the developed world, they must function as hyper-efficient, cutthroat financial engineers, ruthlessly optimizing shale assets and pipeline arbitrage to satisfy Wall Street's demand for free cash flow.
Right.
But simultaneously, in the developing world, they must act as quasi-sovereign utilities. They have to be deeply integrated into the host nation's political infrastructure, providing the baseline energy security required to prevent economic collapse.
The companies that survive the next 20 years will be the ones capable of navigating both of those realities without compromising their balance sheet.
The global energy market isn't a linear machine where you turn a dial and expect a localized result. It is a fragile, intensely interconnected ecosystem. A compressor station maxes out in Texas, forcing a trading desk to monetize a pipeline differential, which funds a water flood in North Africa, which prevents an LNG import cargo, stabilizing a sovereign currency, all while engineers map the subsea contours of the South American coast.
It's all connected.
It is. Understanding the mechanics of that ecosystem is the only way to truly comprehend the market. Thank you for joining us on this deep dive. We will see you next time.